Here's something almost nobody tells you before you retire. The amount of money in your accounts doesn't actually matter as much as you think. What matters is how much of that money you actually get to keep. And that depends entirely on which retirement tax class you fall into. Most people spend 30 or 40 years saving for retirement, watching their 401k balance climb, feeling good every time that number goes up. But almost nobody stops to ask a much more important question. When I pull this money out, how much of it is actually mine and how much of it belongs to the IRS? The truth is, there isn't just one retirement tax bracket. There are 4 completely different tax situations retirees find themselves in. And which one you land in depends on decisions you're making right now, today, whether you realize it or not. Some retirees pull 6 figures a year out of their accounts and pay almost nothing in taxes. Others pull out the same amount and lose a third of it to the IRS. Same income, wildly different outcomes. The difference isn't luck, it's structure. It's which class they built for themselves, on purpose or by accident, over their working years. By the end of this video, you're going to know exactly which of the 4 classes you're currently on track for, why Social Security taxation is far stranger and more punishing than people expect, why your traditional 401k might be a bigger liability than you think, and why a Roth IRA can completely change which class you end up in. Let's break down the 4 classes. The first class is the one most Americans are in without even realizing it. I call this the tax-deferred class, and it's made up of people whose retirement savings live almost entirely in traditional accounts. Traditional 401ks, traditional IRAs, 403bs, and similar pre-tax vehicles. Here's how this class gets built. For decades, financial advice has pushed one message: contribute to your 401k, get the tax deduction now, lower your taxable income today. And that advice isn't wrong exactly, it's just incomplete. Because every dollar you put into a traditional 401k isn't really fully yours. You've made a deal with the government. You get to skip paying taxes today, but you owe taxes later, on the full amount whenever you take it out, at whatever tax rates exist at that time. This is the part that catches people off guard. When you're working, you control your income. You can manage your tax bracket to some degree. But in retirement, if all your money sits in traditional accounts, every single dollar you withdraw counts as ordinary taxable income, not capital gains, not tax-free. Ordinary income taxed at ordinary income rates, the same as if you earned it from a paycheck. Let's say someone retires with $1.2 million, and it's almost entirely in a traditional 401k. That sounds like a comfortable number, but when they start taking required withdrawals, or even just drawing down for living expenses, every dollar is taxable. If they need $80,000 a year to live comfortably, they might actually need to withdraw closer to $100,000 because roughly $20,000 of it disappears into federal and possibly state taxes. And it gets worse from there. The government doesn't let you keep tax-deferred money forever. Once you hit a certain age, currently 73 for most people, and moving to 75 in the coming years, you're forced to start taking required minimum distributions, commonly called RMDs, whether you need the money or not. These forced withdrawals get added to your taxable income every single year, and they only grow larger as you age because the IRS calculates them based on your account balance and your life expectancy. This creates something advisors call the RMD tax trap. Your account has been compounding for decades. By your mid-70s, it might be worth far more than when you retired. Now the IRS forces you to pull out a growing percentage of that balance every year, all of it taxable, whether you spend it or not. Some retirees find themselves pushed into higher tax brackets in their 70s and 80s than they were ever in during their working years, simply because of RMDs stacking on top of Social Security and other income. If you're in the tax-deferred class, your entire financial life in retirement is at the mercy of future tax rates that you cannot predict and cannot control. And here's the uncomfortable truth. Given the national debt and given historical tax rate trends, many financial planners believe tax rates are more likely to rise than fall over the coming decades. If that happens, Everyone sitting in the tax-deferred class is exposed. You deferred the tax, but you didn't eliminate it. You just handed the government a blank check to fill in later. Now let's talk about the opposite end of the spectrum. This is the tax-free class, and it's made up of retirees whose income comes primarily from Roth accounts, Roth IRAs, and Roth 401ks. The mechanics here are completely different and honestly kind of beautiful once you understand them. With a Roth account, you pay taxes on the money before it goes in. You don't get a deduction today. But once that money is inside the Roth and it's been there long enough to meet the holding requirements, every single dollar it grows into is yours, forever, tax-free. Growth, dividends, capital gains, none of it gets taxed again. And none of it gets taxed when you withdraw it in retirement. Think about what that actually means practically. If someone in the tax-deferred class needs $100,000 to live on and has to withdraw closer to $125,000 to net that amount after taxes, someone in the tax-free class just withdraws $100,000, period. No tax bill attached, no IRS involvement. What you see is what you keep. There's another massive advantage that almost nobody talks about, and it has to do with something called provisional income, which we're going to dig into deeply in the next chapter when we talk about Social Security. But here's a preview. Withdrawals from a Roth account do not count toward the formula that determines how much of your Social Security benefit gets taxed. Withdrawals from a traditional account do. That single difference can be worth thousands of dollars a year, and we'll walk through exactly why in a moment. Roth accounts also have another quiet superpower: no required minimum distributions during the original owner's lifetime, at least under current law for Roth IRAs. That means you're never forced to pull money out and create a taxable event you didn't want. You can let it grow untouched for as long as you like, or pass it on to heirs who can also enjoy tax-free growth for a period of time. Now here's the catch, because there's always a catch. Very few people end up entirely in this class by accident. Getting here usually takes intentional decisions made years or even decades in advance. Either you contributed to Roth accounts consistently throughout your career, which many people didn't have access to for much of their working life, or you did something called a Roth conversion, where you deliberately moved money from a traditional account into a Roth account, paying the tax bill on that conversion up front in exchange for permanent tax-free status afterward. This is why the tax-free class tends to be smaller than the other classes. It requires planning ahead. It requires a willingness to pay some tax now in exchange for a much bigger benefit later. But for the people who get there, retirement looks fundamentally different. Their income doesn't trigger higher Medicare premiums as easily. It doesn't push their Social Security into taxable territory. It doesn't create the RMD tax trap. It's clean, simple, and predictable. This next class is the one that surprises people the most, because most Americans don't even know it exists until they're already living inside it. I call this the Social Security squeeze class, and it's built around one of the strangest, most misunderstood corners of the entire tax code: how Social Security benefits get taxed. Here's something that shocks a lot of people. Social Security benefits can be taxed. Up to 85% of your benefit can be included in your taxable income, depending on your other income sources. A lot of retirees assume Social Security is just theirs, tax-free, since they paid into it their whole working life. That is not how the law works. The IRS uses something called provisional income, sometimes called combined income, to figure out how much of your Social Security gets taxed. The formula adds up your adjusted gross income, any tax-exempt interest you earned, for example, from municipal bonds, plus half of your Social Security benefit. That total is your provisional income. For a single filer, if that provisional income falls between $25,000 and $34,000, up to 50% of your Social Security benefit becomes taxable. Above $34,000, up to 85% becomes taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. And here's the part that really catches people off guard. These thresholds have not been adjusted for inflation since they were created back in the 1980s and 90s. That means more and more retirees get pulled into this taxation zone every single year, simply because the dollar amounts have never moved while wages and account balances have grown enormously. Now here's where the squeeze really tightens. Remember Class 1, the tax-deferred class, where every withdrawal from a traditional 401k counts as taxable income? That withdrawal doesn't just get taxed on its own. It also gets added into the provisional income formula, which can push more of your Social Security benefit into taxable territory too. So a single withdrawal from a traditional account can effectively get taxed twice over, once directly and once indirectly by dragging more of your Social Security into the taxable zone. This creates what some planners call the tax torpedo. As your traditional account withdrawals increase, you don't just pay tax on that withdrawal at your normal rate. You can also cross an income threshold that suddenly makes an additional chunk of your Social Security taxable, which can spike your effective marginal tax rate far higher than your official tax bracket would suggest. Retirees in this zone have reported effective marginal rates in the 40 to 50% range on certain dollars of withdrawal, even though their nominal tax bracket looks much lower on paper. It's one of the most misunderstood traps in all of retirement planning, precisely because it's invisible until you actually run the numbers. The Social Security squeeze class typically includes retirees who rely heavily on Social Security as a percentage of their total income, combined with traditional retirement account withdrawals that are just large enough to tip them into these taxation thresholds. It's a strange middle ground. You don't have to be wealthy to fall into this class. In fact, some retirees with relatively modest incomes get hit the hardest proportionally because Social Security makes up such a large share of what they live on. The good news is this class is very fixable with the right planning, which we'll get into in Chapter 6. But if you don't know it exists, you can't plan around it, and that's exactly why so many retirees stumble into it without warning. The fourth and final class is the one most financial planners actually want their clients to end up in. I call this the diversified class, and it's made up of retirees who have deliberately spread their savings across multiple types of accounts: traditional, Roth, and taxable brokerage accounts. The power of this class isn't that any single account is superior, it's flexibility. When you have money sitting in different tax buckets, you gain the ability to control your taxable income every single year in retirement, almost like a dial you can turn up or down. Here's how that plays out in practice. Say a retiree in the diversified class needs $90,000 for the year. Instead of pulling all of it from a traditional account and triggering a big taxable event, plus potentially the Social Security squeeze from Chapter 4, they might pull $30,000 from their traditional 401k, filling up the lower tax brackets efficiently. Then they pull another $30,000 from a taxable brokerage account, where only the capital gains portion is taxed, often at lower long-term capital gains rates. Then the final $30,000 comes from a Roth IRA, completely tax-free, with zero impact on their provisional income calculation for Social Security. The result is that this retiree might have the exact same total income as someone in the tax-deferred class, but pay dramatically less in taxes overall and avoid tipping into the Social Security squeeze zone entirely. Same lifestyle, same spending, radically different tax outcome. This class also gives retirees enormous power to react to changing circumstances. Tax law changes, market conditions change, personal spending needs change. When your money is diversified across account types, you can adjust your withdrawal strategy year by year to minimize taxes based on whatever the current environment looks like. If tax rates happen to be historically low in a given year, you can strategically pull more from traditional accounts or even do a partial Roth conversion. If you have an unusually high expense year, you might lean more on the Roth or brokerage side to avoid pushing yourself into a higher bracket. It's worth being honest, though. Getting into the diversified class doesn't happen automatically. It requires deliberate account structuring during your working years, and often some conversion work in the years leading up to and just after retirement. It's the class that requires the most planning, but it also tends to reward that planning the most generously. So how do you know which of these 4 classes you're currently headed toward? It comes down to 3 questions. First, where does the majority of your retirement savings currently sit? If it's almost entirely in traditional 401ks, traditional IRAs, or similar pre-tax accounts, you're on track for the tax-deferred class, unless you make changes. Second, how much of your projected retirement income will come from Social Security relative to your other income sources? If Social Security represents a large share of your income, and you're also planning to pull meaningfully from traditional accounts, pay very close attention to the provisional income thresholds we covered in Chapter 4. You may be heading toward the squeeze class without realizing it. Third, have you built any Roth exposure at all, whether through Roth 401k contributions, Roth IRA contributions, or Roth conversions? If the answer is little to none, that's the single biggest lever you can pull to shift yourself out of the tax-deferred class and toward either the tax-free or diversified class. The good news is this: your class isn't fixed. Unlike your actual age or your years of work history, your tax class is something you can actively reshape, sometimes even after you've already retired. One of the most powerful tools for doing this is the Roth conversion, which we touched on earlier. This involves intentionally moving money from a traditional account into a Roth account and paying ordinary income tax on that conversion amount in the year you do it. It sounds counterintuitive, paying tax voluntarily, but the strategy often makes enormous sense during specific windows, particularly the years between when someone retires and when they start Social Security or hit the age for required minimum distributions. During that window, income is often unusually low, which means conversions can happen at lower tax brackets than the retiree might face later once Social Security and RMDs stack on top of each other. Another consideration is simply adjusting your ongoing contributions if you're still working. Even directing a portion of new contributions toward a Roth 401k instead of a traditional 401k, even if it's just a percentage split, can meaningfully shift your future class over time. And for those already retired, thoughtful year-by-year withdrawal sequencing, deciding which account to pull from and how much, based on your current tax situation, is often the single biggest lever available. This is exactly the kind of decision where working with a qualified tax professional or financial planner really pays for itself, because the optimal strategy is different for every single person, depending on account balances, other income, state of residence, and life expectancy assumptions. Here's the thing that ties all 4 of these classes together. Retirement isn't just about how much you saved. It's about how that savings is structured. And structure is something you actually have control over, far more control than most people realize. 2 retirees can walk into retirement with the exact same account balance and live wildly different financial lives because of which class they belong to. One pays the IRS a modest amount every year and keeps the rest. Another watches a huge chunk of their nest egg get taxed away year after year, sometimes without ever understanding why. The goal isn't necessarily to force yourself entirely into the tax-free class. For a lot of people, the diversified class actually offers the best combination of flexibility and tax efficiency because it gives you options every single year rather than locking you into one single approach. What matters most is simply this: know which class you're currently headed toward, understand why it matters, and make deliberate choices starting today rather than discovering the consequences by accident once you're already living on a fixed income with far fewer options to adjust. If you found this breakdown useful, the best next step is to actually run your own numbers. Look at your current account balances, estimate your future Social Security benefit, and get a realistic picture of which class you're on track for. The earlier you do this, the more options you'll have to shift your path. Thanks for watching, and I'll see you in the next one.